All right. Good morning.
What's up,
Morning,
guys?
everybody.
Faces.
Morning.
Good morning. Good morning. Good morning, Tony, too. Denise is not going to make it this morning. She is in an area that she doesn't have good signal. Um, Charlene got a good crew on with us this morning.
I saw Charlene got the sale a few days ago. Big win, Charlene. Big good work.
Thank
Charlene, are
you.
you just jumping on to teach a class today, or what are we doing?
No, jumping in to learn some more.
Man, you've been crushing it. Yeah,
Thank you.
congratulations.
Been trying.
Yes,
Thank
yes.
you. Good morning, guys.
Good morning. Good morning. Well, sorry I missed it last week. Me and Logan actually went out to the to Miami to go to Realty One Group's base camp, which they hold every year. So it was a good event. The next event is actually that's more like a owners and leadership meeting. In February, the next event is Summit, which you guys are all welcome to come to. So if you guys haven't seen, they've been asking if you guys, they're buying tickets. If you guys want to go, definitely something that will take you guys get you really pumped and excited for the company. But it is in Las Vegas, so also a good excuse to go to Vegas. But that is in February. Actually, it's the week of the Super Bowl, I believe. So it'll be a busy time out there. But anyways, hope everyone had a good weekend. I spent the day at the pumpkin patch yesterday. If you guys didn't see my social media, so yesterday was a long day, but today we have a very special guest, Michael Caldwell with Movement Mortgage, the man, the myth, the legend. So he's going to jump in. Today's is about financing, right? And obviously, as we know, plays a huge part in what we do and getting it an offer accepted to getting to the closing to the finish line. So he's going to jump in and pop in and introduce himself here in just a minute. But if you guys don't know him, if you haven't sat down with him before, Michael, if you'll put your contact information in the chat, maybe your phone number, name, and email address in there. And then also I can share everyone's contact information from here afterwards. But I know that most people probably at this point, you spoke to someone, a mortgage lender, but it's always good to have a couple people in your pocket, cover your ears, Michael. But I mean, it's always good to have a couple people that you know and that you can rely on, that you know on a personal level. So I'm sure I'd be happy to meet you guys for lunch or something, or have a one-on-one with you. But get to know them, because that's the difference in you guys closing a deal and not closing a deal. Sometimes is a lot of times it's the financing. So I'm gonna share my screen. All right. So today we're going to be going over kind of the basics, the different types to FHA, VA, and conventional loans. He's going to jump into some sponsor programs, the loan estimate, the closing disclosure. Let's see, Brittany, turn that mic on. What do you know
Got
about
it.
the closing disclosure?
It is your form that you are going to, it's going to show all of your numbers.
Right.
You know,
Okay. And when do you get that?
so you're going to get the closing disclosure, what, 3 days before typically?
Yep. Yep. Okay. Okay. Good. Yeah. And Daniel, what about the loan estimate?
Loan estimate is right. You go through kind of the process of applying for the loan, and then doesn't the lender then show you that as kind of like an estimate of where you'll be at, like before everything goes through, like before like you are officially approved for it?
Yeah, it can be. Yeah, I mean that's pretty accurate though. Yeah, it's at the very beginning of the process, right? Um, yeah, so those are both good. So, Michael, I'll let you introduce yourself. Let's see this next one. So again, these are the basic, the three different types of loans, and there's some other things as well, but it's FHA, VA, and conventional. Michael, if you want to go and introduce yourself, and then
Yeah,
I think the
yeah.
first one that pops up is FHA.
Yeah, no, thanks, Brian. I appreciate it. My name is Michael Caldwell with Movement Mortgage. I've had the privilege of meeting several of y'all already. And if I haven't, would love to grab lunch and just get to know you and see how we can work together and build your business. But Yeah, Brian, these are, I would call your nuts and bolts as far as loan programs go. You've got your, what we call government loans. So that's your FHA, VA, and USDA. Those are your 3 government-backed loans. And then, of course, you have your conventional loans that are backed by Fannie Mae and Freddie Mac. Very different loans. I can go into some detail, starting with FHA. So FHA, just to kind of give you guys some understanding, I'll just follow this. So there is a max loan limit. I think it's like 420. I have to look it up, but like 420-ish right now. Those kind of go up and down, or they usually go up every year. The down payment requirement on FHA is 3.5%. There's also a mortgage insurance premium that gets financed in addition to your base loan amount. So you have your base loan amount, and then they finance that MIP to your total loan amount, which is a FHA thing specifically. Down payment gifts, they're absolutely okay for just about all these loans that we're talking about. You got your front end and back end ratio. I will say with FHA, they give you a little bit more leeway with your debt to income ratios. So I've gotten approval just below 57% DTI. So when I'm pre-approving somebody, we verify their income, their credit, their assets. And then once I kind of have a big picture of everything, that's where I decide, all right, well, what's the best program for this customer? And so I'll work with them on, hey, what's a reasonable sales price for you? You know what I mean? So FHA is good because DTI can go a little bit higher than your standard conventional loans. So that's something that we definitely look at. I will tell you this, FHA has mortgage insurance, regardless of the amount that you put down. So you could put down 50%, you'll still have MI on FHA loans. However, recently they dropped the percentage, like the ratio for it. It was 0.85, now it's 0.55. So that MI payment has been reduced this year just to try to help, with affordability with a lot of our buyers these days. Go ahead, Brian.
Yes, I want to ask, Brittany, what do you think a gift is? Like a bottle of champagne?
No, so say for instance, my brother's buying a house and I want to gift him that $20,000 he wants to put down.
Yeah. And so with that, and so a big part of like just working with buyers, and I didn't mean to cut you off, Michael, but just a big part of working with buyers and potential buyers is them thinking they can't afford a house, right? And that's scary for everyone. Everyone thinks they got to put 20% down. Michael just mentioned FHA, it's 3.5% down, right? So I mean, that's a lot less than what people think. Well, guess what? A lot of first-time homeowners, they don't even have 3.5% on a $400,000 house, right? On top of loan originations and closing costs and things like that. Mentioning to them a down payment gift, right? Like your mom can give you 10 grand to go towards your closing, right? And Michael, around that is typically the mom's going to write a letter saying, hey, this is a gift. I'm not asking for any money back, right?
Yeah. So we have basically it's an already written out gift letter. It's a fillable one. So you just have to identify who the donor is. FHA, you got to be a relative. You can now be it's kind of a gray area, but a close friend. So how you define that, that's where it gets a little bit tricky, but gifts are great for down payment. A lot of folks are having trouble coming up with that down payment. And I know everyone's situation is different, but if they have a, relative that can provide that gift, we just need the gift letter to be filled out. So it'll identify the relationship, the gift amount, and the bank information. So Bank of America will need to know like the last 4 digits of the account number, and then the borrower and the donor have to sign the gift letter. And there is a line in there stating that these funds are not to, there's no repayment expected back from the borrower.
Which is a big part, right? Because they don't the government doesn't want to say, hey, like, all right, your payment for your house from 1,800, and then you're borrowing 20 grand, and that's gonna be another 400, right? Because that's your debt to income and all that. So it's got to be like it is strictly a gift. And Michael, this is actually a question for me. Is there a amount, like a cap? Like, it can only go 10%,
Nope.
50%? That can be
Nope.
okay.
It can cover the down payment and all closing costs. There's no limit at all. I will say, I don't know the exact tax implications, but I believe the government has, I think it's 15,000. If the gift is 15,000 or more, I believe there's a tax on that amount that is gifted. So I'll have to look at that, but I've had borrowers bring that up before. So that's just one thing, but yeah, there's absolutely no limit. They can provide all the funds.
Okay. So, but besides Michael, like, what's another way a buyer can get money towards their closing costs?
Yeah, so seller credit, that is one thing that we're seeing today. I'm sure you guys are, coming across offers with seller credit. So with FHA, you have the borrower has to provide the 3.5% down. That's called what we call statutory investment. So that money has to be applied. The rest of it, that can be covered by the seller in a seller credit, or on my end, depending on how I price it out, I can also provide a lender credit. But the credit cannot be more and start going into, it can't be more than the closing costs, basically.
Right.
So in the best case scenario, your borrower puts 3.5% down, and then the rest of the closing costs are covered by your seller.
Gotcha. So just kind of in layman terms, if you guys don't see this, so in the offer to purchase, right? So let's just say Daniel is selling his house and he's got it listed for 300,000. We might put an offer in for 300,000 with $8,000 seller credit, right? Which is kind of the equivalent of you getting, 292, right? But that 8,000 shows up to us at cash at the table to go to cover our closing cost, right? And that is a very good way for someone who's stressing about potentially buying, they don't have all the money, is to get them to understand that they don't need that much money down, right? So, and I as someone that's on the listing side, I get offers all the time to have seller credits. I look at it as a good thing, right? That I know that person, they've already talked to Michael, they know exactly what they need to close, right? And they're going to put an offer in reflecting that, right? So, maybe if the house is at 300 and they're putting an offer and they need seller credit, maybe I say, hey, put an offer at 308. You can have your 8 grand. We still get our 300,000, right? And then that extra 8,000 shows up as cash for you to help you close, right? And that's a pretty standard like negotiation back and forth, right? So on the listing side, when you see an offer that needs seller credit, don't write that off, right? And then you also have to explain to your client, because sometimes clients will be like, screw that, I'm not giving them seller credit. Let's give them no seller credit and counter back at this price, right? My answer is always, we're not countering the seller credit, because they couldn't even put in the offer if they didn't have that, right? So understand that, and say, hey, we can negotiate a price to reflect what you want to get, but understand that that's a good thing. And then understand on the buyer side that, just know where you need to be, right? Like, you need to, that's why working with someone like Michael that's local and that that you can talk to, and say, hey, like, your client's going to need 18,000. What do they have? Well, they've got 10 to cover the 3.5%, but that other 8, I don't know where they're going to get it, right? And he's going to say, all right, well, can you get a gift from mom? Or what if we put an offer on with seller credit, right? And those two things can really, really help you guys. But just from prospecting and just trying to get clients to go see houses, oftentimes they're embarrassed either of their credit, or they're embarrassed because of how much money they have in their bank, right? And just say, hey, look, you'd be shocked how little money you can have in your bank and buy a house, right? Let's get the ball rolling. Let me send you Michael's information. Let's get you approved, and then we can go from there. So those are some things that'll help you get people to at least start looking, if that makes sense.
Yeah, Brian, I'll tell you, I'll share this with you guys too. I've got a chart that has the interested party contributions for every loan program, which means, hey, what's allowed on FHA loans as far as a seller credit. So you can go up to 6% of the sales price for FHA. And of course, we can also apply those seller credits to cover buy downs, which is a big thing we're seeing right now. Just to give y'all an example, I'm locking somebody in at 499 because we were able to negotiate $22,000 from the seller to do a 3-2-1 buy down. So they were wanting to drop their sales price 20 grand, and I was like, no, don't do that. Keep it there, but get the credit. And now I'm able to get them in the 4s, which is unheard of. You know what I mean? So
yeah, that's incredible. I mean, those are just things like I as an agent don't get into the rates ever because I don't know what you guys can offer, right? And that's why having somebody say exactly what he just mentioned, like should, you know, if we lower the price by 20 grand on a $400,000 house, is that going to help them enough monthly payment versus if we took that 20 grand and put it to the rates, that's going to make a much bigger difference, right? Even though the loan is 20 grand more, you're actually going to be paying less, right? Yeah. So those are just the things like having somebody that knows what they're doing is going to help you guys and make you look like the expert, right? Because A, you're recommending somebody, and then B, they're able to give you all this knowledge. Hey, Catherine, yes. You're on mute.
Sorry about that. For that seller 2-1, 3-1, whatever seller buy down, someone mentioned that money, like if let's say rates drop and they refinance, that money's not lost or something, where would it go? What does that mean?
Yeah, it's a great question. So what happens is, let's just say it's $10,000. So the buy down cost is 10 grand. So that 10,000 goes into an escrow account at closing. So we hold it. We don't service, or we service our loans. We don't sell them. So we'll hold the escrow account, and every month the borrower will pay the lower amount, and then the difference is pulled out from the escrow account.
Okay.
So let's say they're doing a 2-year buy down or a 2-1 buy down, and year 1 goes by, and then year 2 happens, rates drop, we refinance them, and there's $5,000 sitting in that account. At the time of refinance, we take that 5 grand and apply it to their principal balance. So it reduces their payoff amount by $5,000. So that money doesn't go wasted. Compare it to a, permanent buy down, which though, you're buying down your rate, you're paying money to lower that rate. If you don't stay in that loan long enough to recoup your costs and you refinance it, that money is wasted. You never recoup your costs, so you just wasted that money. So
Can you do that for an investment property or a second home?
Buy downs or for primary homes.
Okay, thank you.
Gotcha. You want to quickly jump into VA loans? Yeah,
probably my favorite loan out there. There's also, so the VA loan, it's 100% financing. So a down payment is not required. Similar to FHA, the VA has what's called a VA funding fee. And depending on your borrower's funding fee status, which we pull what's called a certificate of eligibility. And on that COE, it'll tell us if our veteran is exempt or not from that funding fee. So if they're not exempt, depending on if it's a first-time use VA loan or whatnot, there's a certain percentage that gets added on to that base loan amount. If they are exempt, then it's if the sales price is 400, our loan amount's 400. So it's 100% financing. There's no additional financing in addition to that. The funding fee is waived. DTI. This is a I don't know if many people know this, but there's not like a line in the sand as far as a DTI requirement goes. As long as we're getting approved eligible through our AUS or our automated underwriting system, we're good. Like we can close that loan. I've had one up to 63% DTI that closed. So DTI is very, very flexible. You just have to make sure you get AUS approval, and we're good. I will say 580. We technically we don't go below 580 on these. But again, if you're 580 and above, getting approved eligible, we're good. Let's see here. think I touched on the veteran eligibility. You have to pull the COE. Yeah, I don't know, man. It's a great loan. It's a great loan. So
Yeah,
it's probably one of my favorite ones out there.
Yeah, I feel like in the past, like people, they saw a VA loan, they would try to like steer away from accepting that, on the listing side. I think they're great. Some subtle differences, but one thing you mentioned the credit score on VA 580. Is there a difference on FHA?
Nope, same thing. We can go as low as 580 on all of our government loans. The key is just maintaining AUS approval, which I will say, if once you get below 620, the guidelines really start to tighten up. They want to see what we call extenuating circumstances. So like reserves, they want to make sure there's no, late payments or anything in the last 12 months. So when you really go below 620, it seems like the AUS starts to get a little bit fine-tuned with what they want to see.
Yeah, makes sense. Catherine, you had a question?
Oh, you answered it. Your question was mine.
Yep.
All right. So let's jump to conventional.
Yep. So this is your standard, what I would call your A1 type borrowers, right? Great credit, good DTI, all that stuff, right? So the max loan amount is currently $426,200. I'm sorry, $726,200.
I was gonna say, yeah, that's
My bad. $726,200. However, we just rolled an early release where we can finance up to $750 for all of our conventional loans, because that's what the new max loan amount is going to be for 2024. And so we went ahead and said, hey, we're just going to start doing those now. So $750 will be the new max loan amount going forward. Anything above a $750 loan amount is considered a jumbo loan. Your DTI requirements, I've gone up to 49%. So on these, you really got to stay below 50% DTI, ideally below 45, but I've gotten approval, just below 50% sometimes. With conventional loans, I will tell you this. We've got two options. We can either run it through Fannie Mae or we can run it through Freddie Mac. There are some differences in their findings. So, for example, let's say I'm not getting an approved eligible at 49% DTI through DU, which is Fannie Mae. I can try to flip it to Freddie Mac and we run it through LP. And I've sometimes gotten approval with one and not the other. So it's my job to really figure out, hey, what's the best situation for our customer and make sure we get it done, right? So there are two options that we can run through Freddie or Fannie.
What
What's
about a down
LP?
payment amount?
Oh, sorry.
Sorry, say that again.
What about a down payment amount?
Yeah, down payment. So you can go as low as 3% if you're a first-time home buyer. If you're not, it's standard 5%.
Okay.
And the biggest thing with conventional loans is there is no mortgage insurance if you put 20% or more down. If you put less than 20% down, you will have mortgage insurance, which can be paid in multiple ways. So the standard is usually monthly. You can pay it in a monthly payment. You can do finance. You can finance it if you want to do it that way. Single premium is where you just pay it all in a lump sum at closing. And then you can get really kind of tricky if you want to and do what's called split MI. So where you pay a portion of it in a chunk at closing, and then you have a smaller monthly payment as an MI. So you can even do lender paid, where you take a higher interest rate and we do away with the MI that way. So just know that there's some strategies to pay that MI on conventional loans.
Catherine?
What you mentioned LP, like running it through Freddie Mac or Fannie Mae and LP. I just didn't understand what that meant.
Yeah. So with conventional loans, you've got Fannie Mae and you have Freddie Mac. Those are our two entities that we have to run our conventional loans through. Fannie Mae's automated underwriting system is called Desktop Underwrite, so DU. Freddie Mac's is called Loan Prospector, which is LP. So you got DU and LP.
Gotcha.
Oh, I'll touch on this too, Brian, real quick. I am seeing, depending on the down payment amount, property inspection waivers on conventional loans. I've got one closing this week where the borrower is putting 20% down. I ran it through Fannie Mae or DU, did not get a property inspection waiver. I flipped it to LP, and Freddie Mac did give me an inspection waiver, meaning an appraisal is not required on that loan. So again, there's strategies on kind of flipping through both of them to, you know, make sure we get the best deal for our customer.
Of course, yeah. So obviously some common challenges you guys are going to get, and you guys are going to get a lot of this up front, while you're talking to your clients and maybe why they don't want to buy. But also some of the stuff is going to pop up once they tell you, I've got great credit, I've got no problems. And then Michael gets it and it's, all right, well, you've got a couple of liens. So obviously their credit score, divorce, child support, liens, which I've had to happen to a couple of my clients this year, like several times, name changes, aliases, and things like that. So those are things you guys are all going to run into. Ideally, you know, a lot of this stuff going into it, as opposed to knowing that, you know, a week before closing, the attorney finds out there's a $10,000 lien on the house. And really the option there is it's coming out of the sellers. If it's on the listing side. I'm sorry, I'm always on the listing side, but any other challenge you normally see, Michael?
Yeah, so this is the most common thing I hear from all of my buyers regarding credit score. They say, well, hey, my my freecreditreport.com score says I've got a 750, or Credit Karma, I've got a 750. And then when I pull it, a mortgage credit pool, it's a 680. And they're like, well, why is it so different? So you guys might hear this all the time, but there are different scoring models when it comes to credit reports. There's different algorithms and all that kind of stuff, but we use a FICO credit score, which is pulled by the 3 credit bureaus. And it is a much different report than the ones we can pull for free ourselves. So, you know, I always err on the side of caution when someone says, yeah, I just checked my scores there, whatever, right? Because a lot of times they're going to be different when I pull it on my end. So just be aware of that. Divorce. I know we had a great training the other week with Lindsay, who's a divorce attorney, gave us a lot of great information. Child support can be a killer because we have to add that to the DTI if the borrower is making child support payments. And then on the flip side, if you're receiving child support payments, there's some guidelines that we have to have in order to count that as income. You know, basically you got to have, proof of receipt. You got to have proof that it's going to continue for at least 3 or more years. And typically you want to see that on a divorce decree or some type of separation agreement. Judgments and liens, usually we figure that out pretty quickly. Most of the time those are found on the credit report if it's on the buyer side. And depending on what that looks like, we have to handle those one way or the other, whether that's getting them paid off or whatnot. And then like Brian said, I've got one with a judgment on the seller side, and it's just getting added to their line on the CD to get paid off at closing, and it'll be taken from their net proceeds. And that was found when we ran the title report on the property that my buyers were buying. So a lot of this stuff, you know, you can typically catch up front, but it's always good to handle this stuff as early as possible in the process.
Definitely. So
I have a
Daniel,
question.
appraisal. Sean, do you have a question?
Yes, but I'm
Go
sorry,
ahead.
you can go ahead.
Yeah, go ahead.
Michael, quick question. So, do you guys run soft inquiries or all inquiries, hard inquiries that's going to show up on there? Because that's a question that I always get from clients.
Yeah, it's a great question. We have an option where I can run a soft pull. It's run through Experian, which is one of the 3 credit bureaus. It's it doesn't, won't affect their credit score or anything like that. I will say, just from my perspective, I would rather, depending on like their time frame and how serious they're ready to move forward and really buy a house, I like to do a hard pull, just because one credit bureau might not report something, and then when I pull the other two, I got a bankruptcy that's reporting, and now we can't do the loan. And if I hadn't done that, you know what I mean? So soft pulls are good depending on their time frame, but for me, I'd rather, I don't want to leave anything uncovered.
Okay, and one more question to follow up with that. So say if a client they want to shop with multiple mortgage officers, right? If you pull it and someone else pull it, does it still affect their credit, or does it only affect it that one time?
Yeah, good question. So the credit bureaus are supposed to give the consumer a 30-day window to shop. And I mean, I can't say for certain that it won't pull down their scores a little bit, but they're supposed to be allowed a 30-day window to shop.
Okay, that's what I thought. I just needed to confirm.
Yeah, no, that's a great question and great question, great answer. Most people don't know about the 30-day to shop, but again, to kind of reiterate, I think if your buyer is serious and they need and want to buy and it soon, like either way, they're gonna have to have a hard pull. Like, why not? I mean, you might as well go ahead and do it now, as opposed to your client thinking that they're going to be pre-approved and you're putting $5,000 down due diligence, and then we get into the process and there is a bankruptcy that we didn't know about, right? And then now they've lost that $5,000, and because they wanted to protect their credit, you've actually cost them $5,000. Now they're mad at you, right? So Michael, not to speak for, I think that's kind of what you're getting at, right? Like if they're not in a hurry and maybe they're going to buy in 6 to 9 months, maybe a soft pull is fine now.
For
But
sure.
if we're getting nitty gritty and we want to close in December, let's go ahead and make sure there's nothing hitting.
Yeah, I don't like to mess around. I mean, it's so another thing that I do, depending on, their income structure, and their just overall approval. But like if they're a salary W-2, low DTI, like I call it a layup loan, right? An easy loan. Like I don't really need to submit that to my underwriter to have them review it for me to give a pre-approval letter. But if we're looking at self-employment, multiple rental properties that we're using income for, or self-employment or a variable income, I'm gonna get that into my underwriter so they can nail all of that stuff down so we don't have any issues at all, because that you don't want to mess around with that. So in order for me to send it into underwriting, I do have to do a hard credit pull, which is, all three. So it is kind of a, case by case, but if they're a little bit further out, we can do a soft pull. That's fine.
Okay,
Gotcha.
and one more thing, because I don't see it on here. Do you guys do USDA loans?
Yes, we do. Yep.
Okay.
Michael, I think a lot of people want to shop around because they're always wanting to find the best rate. And are you keep all the loans in-house? Are you a broker? Can we tell them, Michael will shop all these different programs? I mean, what can we say? Are you a broker, or do you just do them in-house? What's your...
Yep. We're a private
expertise?
lender. Yeah. So we're a private lender, privately owned. We just have just about every loan program under the sun. We don't, we're not a broker and where we can like shop different rates from different third parties or whatever, right? We have our own rate sheet. However, we do have a broker outlet in the sense that we can't go do a traditional loan, right? So what I would call your non-QM loans, or kind of your weird like DSCR, bank statement type loans, we have an outlet for that. But your standard FHA, VA, conventional, USDA, everything's in-house. We don't sell our loans, we service them, which I will tell you is huge, because what we want to do is be the borrower's customer for life. And by doing that, whenever it comes time to refinance them, we waive all of our lender fees. So we make the refinance very affordable, and we don't charge them lender fees on the refinance. So it's just a strategy we've had. It's probably been the best decision we've made in this environment to service our own loans.
Okay, and is there a certain time frame, like you can not refi until 4 months, or you can't refi for free, like you said, after 2 years, or what's the limits on the refi?
Yeah, there always has to be a benefit to the borrower, right? And so
Sure.
that's determined by, you know, if we're doing a rate term or a cash out or whatever. But there is what's called an early payoff period, which means, you know, if we close a loan today, typically they want to receive up to 4 to 6 payments before that loan gets paid off, whether that's, you know, the borrower sells their house or they do a refi. Because there are some implications that I have to face if that loan is paid off early. But yeah, on a refi, there always has to be a benefit to the borrower to do it.
Right, and then you said you could refi at any, like in a year, 2 years, anytime that customer can refi for free with you.
Yep.
As long as you're past that 4 to 6 months, so you don't have to like recapture that loan or eat it or whatever it's called.
Correct.
What's the term?
Yeah. As long as we're servicing the loan. I mean, we don't service our jumbos. We don't service a lot of the like bond loans, like the state North Carolina housing type. We can't service those, but the majority of our FHA, VA, USDA conventional, we're servicing.
I have a quick question, Michael. What about assumable loans? So to make the loan assumable, when the buyer first gets the loan, do they have to say that they want it to be an assumable loan? I've just been seeing that kind of thrown out here in today's market, and I just really want to know.
Yeah, I think the attraction is, well, they refied in 2021, their rates of 2%. Here's the thing with assumable loans. As a loan officer, I'm completely out of the picture. Everything has to go through the company that is servicing that loan. Okay. The other challenge is the buyer has to come up with the difference of the sales price and what's owed on that loan. And I've also been told it's a 60 to 90 day process to close that. So it's not like a 3-week turn time that we normally have on these things. It's a long, drawn out process because they have to go through the servicing department that is holding that loan. So in theory, it's a good idea, but realistically, I don't know. It takes a long time.
Okay, thanks.
Yep.
Yeah, I think in theory it's great, but I mean, someone that has a 2.99% rate in their house, 300,000, you know, a couple of years now that the rates are 8%, but that house is worth 450. Like, is your person that concerned about a couple of percentage? Probably because of their monthly payment. Do they have 150,000 make up that difference just to get that rate, right? Yep. So the chance of it working out is pretty slim, and then also the chance of the seller wanting to wait that 60-90 days for it to close is also not ideal for them, right? So and just to kind of go back, I try to lead my buyers away from like the whole let's go shopping, right? Like we want to go shopping for houses, not for our rates, right? Because there's so many misleading things. I mean, you might see Bank of America, I can do 4.99%, but what are you doing? How are you getting that rate? What are you paying for? Maybe it doesn't make sense to buy rates right now. Maybe it does. But at the end of the day, I try to steer them like you want to work with the person, right? Because at the end of the day, not everyone can do the same thing, but they kind of can. But you want somebody that's very knowledgeable about what they're doing and someone that's local that you can physically talk to and touch if you need to, right? So I try to steer them away from like, hey, like go to your bank, talk to this person, let's get 4 different things. Like instead, let's find someone that you like and you want to work with. Because it's the same thing about real estate as well. Like at the end of the day, like, hey, this is a relationship. I want to work with you. They're like, yeah, I'd like you too, Brian. I want to work with you. I want it to be the same thing with the lender, right? So it makes the process a lot smoother. Obviously, you're going to have some people that are numbers. But if you can steer them away from that, it'll make your job a little bit easier.
I couldn't agree more. I mean, obviously, as a lender, you know, I think it's important that you guys have your lender, have your local lender that you can call and text and you'll get a response. Just the overall experience will be way better if you have somebody that is your go-to.
Go ahead.
Yeah, go ahead, Brian.
I can tell you just earlier this year, I had they had a loan company on the West Coast. Getting a hold of them was a nightmare. And just the whole process was tough. Day of closing, we needed something by I think 4 p.m. our time, and their 4 p.m. is 3 hours later. We ended up missing the closing and had to go to the next week. So their rate lock expired. It was just a nightmare. Just the whole process can be tough, right? Like, so these virtual companies sometimes can be tough, right? Like versus someone that like, if I can go to Michael's office and like, hey, what's going on? Like, versus he doesn't like me just to show up, but I mean, like theoretically I could, right? But he'll pop on a Zoom with me. But again, there's a lot of online stuff, and that sounds great online, but again, it's a relationship, and you're working with these people because not only is your buyer locked in with them, you are too, right? And if you can't get a hold of that lender, that's really tough.
Absolutely.
So we're
I am
kind of
currently dealing with that now.
Oh yeah.
With a new construction. So, gosh.
Yeah, and I'll touch on that real quick. So
Yeah,
new construction, a lot of times they're going to pretty much force your buyer to use their internal lender, and they'll offer incentives that I can't provide. So I get it, but Charlene, you're seeing the difference, right? I mean, it's no fun.
Yeah. So it's not uncommon. Again, you don't have to use like on the new buys, you don't have to use them. They do offer incredibly good incentives. Usually what I say is at least apply for that, the lender through the new build, and then you can still be going through Michael and compare as it goes along and see what's worth it. But again, there's times like you're going through right now where it's just it can just be tough, but just stay on top of them, keep all that communication that you're reaching out. So keep that for record. So real quickly, we kind of touched on this earlier, the loan estimate provided by the lender within 3 days of the loan application has been your basic information as much as he's able to gather right away, just the basic information and loan amount terms. The closing disclosure is I missed some of this. At what point are you locking in the interest rate? I think that's a
good question. So I'll kind of walk you guys quickly through my process, but ideally I want to have the loan already fully pre-approved before I get a contract. So really all I'm doing is if I get a contract today, I'm just plugging in, sales price, down payment. As soon as I put in the subject property address, that triggers what we call a TRID application, right? So I've got 3 days to get that loan disclosure out, which includes, a loan estimate in there. But as soon as I trigger a live loan application, I can lock in the rate. And obviously my rate has to be good through our close date. Or you can float and get disclosures out and then lock at a later time. But yes, within 3 days of me triggering the app, they will get a full loan disclosure. Everything's e-signature. And part of that disclosure is the loan estimate, which pretty much breaks down all your estimated terms at that point.
And not to go down a rabbit hole, but so I feel like the rate lock thing is something that, it's kind of a buzzword and everyone hears about that. Like, when can they lock rates in and how long is that locked? And obviously if rates drop tomorrow morning for some reason, it goes down to 6.75, like let's lock our rates, and like explain like how that works and the benefit of that.
Yeah. So this market has been the most unpredictable market in the 10 years I've been doing this. I am heavily on the side of let's not mess around with this and let's lock it in. You might see a day where it comes down a little bit, but then the next day it could go way up. So I mean, it's just been crazy. So I'm not an advocate for floating in this environment that we're in now. So as soon as I trigger the application, I have a conversation with the borrower and I go over all of our rate lock options. We have rate lock periods starting within 15 days, 15, 30, so-and-so, all the way up to 90 days. I can lock in a rate without it being an extended lock, which I'll explain that in a minute. But the further your lock period is, your pricing gets a little bit worse, right? So just keep that in mind. But yes, the lock period has to be good through our close date. So if I do a 30-day lock period, that loan has to get closed within 30 days. If we close on the 31st day, that means I have to do a 1-day extension to get that rate lock period to go through our close date. And when there's an extension, somebody has to pay for it, whether that's me or the buyer. And if it's on the buyer, obviously we want to try to eliminate that as much as possible. But in some cases, I'll be like, screw it, I'll just cover it so we can close, you know what I mean? So just keep that in mind. Rates have to be good through our close date.
Yeah, so that can get tricky because it's usually down to a couple of days, right? So, what if the seller who's also buying a house, they get delayed a couple of days, right? Now they can't sell their house, right? So I mean, it happens. So those times that you hear like, hey, it cost me an extra $400 to lock this rate in for an extra 2 days. Like we either, so that stuff comes into play. Just real quickly, so the benefits is obviously it protects you from going up, right? The downfall theoretically is like if rates drop 1% tomorrow, I'm screwed. Like what's your answer to that?
Yeah, so I call it legalized gambling. That's what we're doing. But yeah, I mean it's very rare that rates will drop within your lock period enough to do what's called a rate renegotiation. Don't be confused with the percentage points, but the cost of the rate has to improve by 100 bips or 1 point in order for us to do a rate renegotiation. And then it's a little bit of a complicated thing on my end, but basically I have to go back to the day that I locked the original rate, and then I have to pull the current pricing of today. And then our rate lock team does some stuff on the back end, and then I can renegotiate that rate for the borrower. But again, it has to improve 100 basis points from the time we lock, which is very rare, but it can happen.
Gotcha. Again, we're getting closer at 10 o'clock here, but monthly payment, in today's world, a lot of people, they're shopping not on the amount of the house, but what their monthly payment is going to be, right? I see Charlene shaking her head. Yes. For those people, and again, people are always like, well, how do you decide what they can afford? Again, they should be pre-approved first, and they should, Michael's gonna be able to give them a range like, hey, like if you need to be between 24 and 2,600, you can afford a $375,000 house. I'm just making up random numbers, but I mean, that's kind of what you're not coming up with those numbers. That's something that you're typically going to ask, the lender. But a lot of people are going to shop monthly payment wise, right? So just know that, and he's going to be the one to give you that information. Yeah. Closing costs, prepayment. We'll go through some of this stuff. Again, the CD has to be provided to the buyer 3 business days prior to closing. So I mean, if you're Charlene with your new build, I mean, I'm sure they've got it because they're the builder there, but if you're closing on Friday and it's Tuesday or Wednesday and your lender hasn't provided the buyer the CD, then you're not closing on Friday, right? So now that they've got their moving truck lined up, they've got help to move that weekend. It's not closing. All that stuff is gone, and you're going into the next week. Now maybe your rate lock is gone. You've got to explain to the seller why you're not closing on time. That's why it's very important to stay on top of your lender and know your lender. Because ideally, Michael, I mean, he's going to call me. He's going to let me know. He's going to give you everything that they need to know. Like, hey, this popped up. We need to do this, this, and this so we can get the CD out today, right?
Yeah. I'll touch on this really quick. So what we do up front when my assistant submits the loan to underwriting, it gets assigned to an underwriter and a processor. The first thing the processor does is sends a title request to our attorney for them to do the title report, but also for them to send us their fee sheet. So when we get to a certain point of the process and we have their fee sheet, we have a team that goes in there and adjust any of my estimated fees from the loan estimate and corrects them based on the attorney's fee sheet, gets it all restructured, and sends the initial closing disclosure out to the buyer at least 3 days before closing. I like to have it done at least 10 days just so there's no, worrying about it. But that goes out in an e-sign format, and the day they sign it is day 1. So you got 1, 2, 3, then you can close on day 4. Saturday counts as a day, but Sunday does not. Sundays and federal holidays do not count as a day. So you just want to make sure, you're doing your math and counting the days right, so you don't have an issue where that wasn't signed at least 3 business days before closing.
Now, this is into the weeds, but there's times where that CD is signed and maybe something changes on there, but it can still count the original effective date. Is that?
Yeah. So if the APR increases by 1/8 or more, we have to send what's called a redisclosure. In other words, disclosing to the customer, hey, your fees went up higher than 1/8. And so now that starts all over again. So we try to make sure there's going to be no major changes in that loan estimate or closing disclosure for us to have to redo it. So a good example would be, let's say I sent the CD out, they signed it, and then we have to push closing out a week, and I have to charge my borrower the cost of the rate lock extension. Well, on my original one, I wasn't charging them anything, but on this one, now that we're pushing closing out, I'm charging them maybe a 1/4 point to cover the lock extension fee. I have to redisclose that to them, and then that time frame starts over again. So it can get a little bit tricky. There's also what's called a change of circumstance letter that can go out, and sometimes you avoid the 3-day wait again. But it just depends on kind of the APR situation.
Oh, long story short, people, the week of closing, the week before closing, make sure everyone's ducks are in a row and everything is good to go. You do not want to show up to closing and nobody gets to close.
Nope.
We kind of talked about all this stuff.
I'll add to, even on the listing side, call the lender.
Absolutely.
Just to make sure, because that's what I had to do this time. This was my first transaction, but I was on top of everybody. Just and
I
Brian,
wonder who told you to do that.
Yeah, you did. That's what I'm saying.
Yeah, I love when I get a phone call.
I had to do it.
Yeah. I love when I get a phone call from the listing side, the lender. I love, and Mike, I don't know if you always do that, normally do that, but it's good because a lot of times that buyer's agent is not giving me all the information I need, and I'm asking for stuff and not getting it. And I'm gonna ask me, hey, give me their contact information. Let me contact them directly. And I think I think it's great for everyone involved in this, instead of playing telephone, right? Because as a seller's agent, I mean, the listing agent, you're panicking too. Is their loan going to close? Are we going to be able to close on time because we have to move out too? So.
Yeah, I communicate with both agents and borrowers just constantly. I think that's what makes the experience go well, is just transparent communication. Good news, bad news, no news, communicate. Bottom line. And then Brian, real quick. So you get your loan estimate, you get your initial CD. Once the loan's clear to close, it goes to a closer. The closer and the attorney balance the final CD. We issue that to the borrower so they know the exact amount due at closing, and then they'll end up signing that at the closing table.
Gotcha. Yeah. Good. Thank you. Catherine?
Brian, where's that mortgage calculator? I just saw you click through it. That's in our Realty One stuff. Where's that
your
at?
Realty One group, the app that you have.
It's on the app under what?
I'll send it to you. I actually don't have the.
Okay. I just thought it'd be
send it to you.
helpful. I used to know how to calculate that and I've forgotten. I thought that might be handy. Thank you.
No, yeah, of course. Yeah. And again, I try to always keep myself out of that, the whole mortgage stuff. So I always just send it to Madeline. That's kind of the way I do it. And
I'm looking for myself. I need an investment too. I need to know this for me.
Gotcha.
Thank you.
So that kind of brings me up to the next thing. And Michael, I don't know how you always prefer to get the information, but for me, whether it's I'm on the, we're helping a buyer out or I'm helping my seller out and they're about to buy, a lot of times we recommend like, hey, like, if do you have a lender? Do you have someone that you want to use? And they're always like, well, I'm open to suggestions. Like, I've got a guy, like he'll take care of you hold your hand through the whole process, right? And if they're okay with that, right, I'm just going to send Michael an email and say, hey, Michael, I met with Cindy this morning. She's currently renting. She's looking to buy in a house. Here's her email address, phone number. Like, I'll let you guys take it from here. Thanks for helping out, right? And that's kind of it. I'm not promising Cindy that he's going to give her some crazy rate. I'm not promising her that she's not going to have any down payment. Like, I'm just like, this is the person that I trust, and he'll stay in communication with all of us. And then that's it. Michael, can you, I mean, that's how you prefer?
Yeah. I mean, the biggest thing is, once you guys connect me with the potential buyer, I always schedule a separate time to have a phone call with them. And part of that phone call is just getting to know them, right? Getting to understand their situation, build that rapport with them, and then kind of dig into the details. Hey, what's your time frame? When do you want to be in your new home? I ask them some qualifying questions. So, hey, what do you do for work? How are you paid? Do you have any other properties? So on and so forth. Just so in my mind, I know what documents I'll need for the pre-approval. And then once we end the conversation, I send them an email with instructions on how to do the app. I give them a list of documents. And then when they complete it, that's when I jump on it and do my full upfront pre-approval. And I can't stress enough, especially in this environment, to get a full pre-approval versus just a pre-qual, right? If y'all know the difference, pre-qual is as good as the piece of paper it's on. A pre-approval, again, we're verifying income, credit, assets. I'm even having my underwriter put their stamp of approval on it before they get in your car and go look at a home, right? So you want to make sure you have a solid pre-approval before you waste time showing them all these houses.
Another benefit of having someone that you know and trust and like is, Daniel, maybe you meet someone today at tennis and they're very early in the process. They don't know, maybe they need credit repair. Maybe they've never bought before, right? Introduce them to Michael. Like, let him take care of that process and get them approved. And guess what? When he gets them approved, guess who they're going to use as their agent, right? He's not going to let them go to another agent, right? He's going to bounce them right back to you, right? So there are times where I have somebody I have no idea if they can buy a house. I'm like, hey, let's get you pre-approved first, and we'll go from there. Again, I'm almost always one to show anyone at least one or two houses to start with. But there's just times where you don't know what they can and can't do. And he's happy to start that process and find out if they can buy. So I mean, and again, it's just you have people in your bag, right? And recommending the mortgage person makes you look like the expert. Even though some of you guys haven't even done a transaction, you've been able to recommend hey, I trust this guy, I like this guy, you're the expert. They're going to be more confident in you. And then when they get to a point where they can't buy the house, that's coming right back to you.
Absolutely.
So.
Yeah, I mean, it takes a village to be successful in this business. And if you can have trusted people in every area, I mean, it'll do you well.
Definitely. Well, does anyone have any other? We've had a lot of great questions. Michael, you've been awesome as always. Any other questions?
I had one question, guys. I talked to a few lenders just in meetings, and they had mentioned the down payment assistance. Some people can get approved for that. Are there specific requirements or characteristics of a person to be able to get approved for that?
Yeah, good question. So there's some different down payment assistant programs out there. The majority of them are state specific that go through a state agency. So you got North Carolina Housing, you got House Charlotte, you got some of these other ones, and they have their own specific guidelines and requirements. So I can send you guys the website just to kind of look through it. But yeah, you got to have I think 640 credit. You got to have a household income limit. It's got to be under a certain threshold. DTI I think is at 43%. But they're all, they all have their own specific guidelines. We've got our own in-house down payment assistant program. It's a FHA loan. But it's not state specific. We can do the loan any state except for New York. That's the only one we can't do it in. But yeah, I mean, it's out there.
Gotcha. Anyone else? This was good. Charlene, thanks for taking time to stop Stone House for 5 minutes and join us. Everyone else, great seeing you. If you haven't, I mean, he put his information in the group chat. Shoot him an email if you haven't connected with him before. Introduce yourself and schedule time to meet up with him in person. But I appreciate everyone jumping on, especially you, Michael. And if you guys have any questions, reach out to me. If not, I'll see you guys next Monday.
Yeah, thanks, guys. I'm gonna send you an email with a couple of things that we talked about today. And please just call me, text me if you have any questions whatsoever. I'm here to help.
Awesome.
All right. Thanks, guys.
Thanks, everyone.
Thank you.
Bye.
Thank you. Great week.